Good morning. Welcome to the second electricity rate review related public consultation by the Independent Regulatory Commission. The IRC, of course, is the regulator of the electricity sector, which is responsible for reviewing electricity rates in Dominica according to the Electricity Supply Act. My name is Idona J. Baptist. But before we get into the crux of the matter, I would like to invite Mrs. Florestine Felix Laura to deliver a word of prayer. Good morning, let's stand for prayer. I'm not going to preach, okay? Heavenly Father, this morning we reverence your presence here with us. Holy Spirit, we welcome you. Father, we thank you for your loving kindness and your mercies and your grace towards us. This morning, O God, we are ever thankful for you are indeed our Almighty Father. So today, Father, as we come before you, we thank you for all that you have done and all that you continue to do for us. Father, we know that everything good comes from you because you are a good Father. And you told us to ask and we shall receive. So today, Father, we plead for your presence. We ask for your presence, your grace, your mercies, your understanding, your knowledge, and more so your godly wisdom as we go through today's activity in terms of our public consultation. We pray for open hearts and minds to receive the plans and the purposes of today's events. May we be sensitive, O God, to your leading and obedient to the voice of your Spirit. Father, we pray that you will continue to open our eyes, the eyes of our understanding, to see your hand at work in every aspect of this meeting. And as we ask for a spirit of unity, may your Spirit continue to guide us in making wise decisions and lead us towards the best outcomes. We pray, oh God, that the technology and everything involved, Father, in making this meeting a success will be done according to your will and for your glory. In Jesus' name we pray. Amen. Amen. Thank you, Mrs. Laura. So today's consultation specific focus is on the weighted average cost of capital for Domlec, our sole electric utility company. In February, we would have held a consultation to discuss Domlec's proposed depreciation rates. Of course, this is part of a broader process as part of the electricity tariff rate review, which began in 2021 with Domlec first making an application to the IRC for a rate review. Allow me to recognize the members at the head table. To my left, immediate left, is Mr. Justin Case, the Executive Director of the IRC. To his left is Mrs. Connie Joseph Louis, the Financial Analyst of the organization. And this morning we have a special guest. To Mrs. Louis' left is Ms. Tioka Dove of RTI. RTI is currently conducting an institutional assessment of the IRC, and Ms. Dove will facilitate our question and answer segment this morning. Of course, the reason why you're here is because the IRC is giving you an opportunity to share your concerns, give your feedback, and seek clarity as it relates to the proposals made on the weighted average cost of capital for Domlec. The next part of our program is opening remarks and summary of the consultation document by Mr. Case. I will now invite him now to the podium.
Good morning, everyone. On behalf of the Independent Regulatory Commission, the regulator of the electricity sector, and Domlec, your electricity utility and provider of that service, I'd like to extend a warm welcome to all of you. It's a pleasure to have you here today. Our most recent public consultation was, as we advanced with the tariff review, was in February this year, when we consulted on Domlec's depreciation study. And today we gather to explore and discuss the intricacies of the weighted average cost of capital, or what we refer to in short as the WACC. Its crucial role in our financial decision-making processes for the electricity utility company, that is Domlec. As many of you know, WACC is the fundamental metric that helps us assess the average rate of return required for all our investors in both equity and debt holders. It's a crucial element in evaluating the feasibility of investment opportunities, optimizing capital structure, and ultimately guiding strategic financial decisions in securing the sustained viability of Domlec. In defining the average rate of return as cited above, for the layman and to enhance clarity, our presentation teams will proceed to do their best in upcoming presentations to communicate as simply as possible this metric to everyone. In general, a fair average rate of return for the utility must satisfy two controlling texts. It must not be confiscatory of the stakeholders' property without just compensation. And two, the retail rates resulting from the cost of service, including the reasonable rate of return, must result in a balancing of investor and consumer interests. Today's consultation is an opportunity for us to dive deeper into how we have calculated the WACC for its application. We will discuss various methodologies, recent changes to financial markets, and how these factors influence our WACC computations. Our goal as the regulator of the electricity sector is to ensure that we have a clear and consistent approach that aligns with our strategic objectives and supports informed decision-making. We are confident that your attendance and participation today as stakeholders, and as much as possible your expertise on this subject, that your insights and feedback as consumers of electricity will be invaluable to the discussion and decisions that are and will be taken. Thank you for your time and participation. We look forward to a productive and engaging discussion. Let's get started.
Thank you, Mr. K. So let's get started. Indeed, you will realize there's a screen with a gentleman on. This is Domlec's consultant, Mr. William Vinage, the consultant that was responsible for reviewing Domlec's weighted average cost of capital. Unfortunately, he could not join us here in person due to the inclement weather. So Mr. Vinage is joining us from Florida. Also, Domlec's Chief Financial Officer, Mr. Clyde Edwards, is also on the Zoom call. So I would like to acknowledge these two gentlemen, Mr. Vinage and Mr. Edwards. And actually, next up on our agenda is a presentation by Mr. Vinage, the consultant for Domlec, on the proposed weighted average cost of capital, who will share Domlec's determinations with you stakeholders. Tech support, please connect Mr. Vinage.
I think I'm supposed to be speaking now because the audio on my end is very poor. Can you hear me?
We are hearing you fine, Mr. Vinage. Well, I'm hearing you fine. I suppose it should be the same for the rest of the stakeholders.
I'm sorry, I didn't quite get what was said.
We are hearing you. We are hearing you.
It's very low and muffled. I don't know if you can get closer to the microphone or...
You can go right ahead, Mr. Vinich.
Maybe someone could just text me what you're saying, because I'm not making it out.
Okay, tech support is messaging you now. Tech support, please message him.
Okay, and okay, I will commence. Let me see. Share screen. It's saying that you need to allow me to share my screen. I can't do it. Still not able to do it. Okay, now I'm good, thank you. Does everyone see my screen? I'm going to take that as a yes. Okay, thank you for being so understanding with the travel difficulties. I made it as far as San Juan the day before yesterday, and was told that I could not get to Dominica before Friday, given the conditions. So I appreciate the flexibility and going the Zoom route. I've prepared a presentation to walk through the study I did for Domlec on the weighted average cost of capital. This study was filed last year sometime, and we've been we've been iterating with the IRC and their consultant for the past several months, and I think we've converged on a middle ground that is acceptable to Domlec, and hopefully the IRC and hopefully the public will receive it well as well. Basically, I've walked through this, just basically gone through some first principle discussions, capital structure, the cost of debt and the cost of equity, which are the two principal sources of capital for Domlec at this point, and then just a brief discussion of how we've worked to kind of synchronize the various approaches. At a very economics 101 level, the cost of capital is the opportunity cost of your investors, both capital and debt, that they have. Basically, the economic reality says that if they can sell their investment here to get a better return for investments of similar risk, they will do that. So the company really needs to set a cost of capital to be able to attract capital investment, both debt and equity, so as to be able to operate and maintain and expand the electric system in a safe and reliable manner. Debt and equity, as I've already mentioned, are the sources of capital. The debt cost is relatively straightforward. Domlec either issues bonds or takes out loans with banks, and the cost of those bonds and loans are directly observable as the interest rate that Domlec pays on any of those loans it's taken out or the bonds that it has issued. Unfortunately, with the cost of equity, it's not that simple. It is the opportunity cost of equity investors. It's not directly observable, and the typical means by which these costs are estimated is looking at stock market data, because that basically underlines the selling of investments and purchasing of investments, and from that activity you can glean the return. Excuse me. You can glean the returns that investors are expecting. And then the weighted average cost of capital is just the weighted average cost of the debt and the equity. So these two formulas basically say the WACC. I'm going to call it, whenever I say the word WACC, I mean weighted average cost of capital. The WACC on an after-tax basis is equal to the percentage of debt in the capital structure times the debt cost percentage plus the percentage of equity in the capital structure and the equity cost percentage. The debt percent and the equity percent add up to 100%. So your capital structure consists of both debt and equity, and what the capital structure says is, okay, what portion of that is debt, what portion of that is equity. The difference between the pre-tax and the after-tax amount is, you'll notice in the last piece of that formula, is that the company needs to pay income taxes on the equity returns. So the equity return is divided by 1 minus the tax rate, and that increases the cost to account for the income taxes that need to be paid by Domlec to the government. How this WACC is used in the rate process, it's basically one of the key elements of the revenue requirement that determines how much revenue the company needs, and that consists of the elements of operations and maintenance expenses, fuel expenses, independent power purchase expenses, the depreciation expense, which you've already had a public consultation on, and then the rate base times this WACC on a pre-tax basis. And the rate base is just it's primarily the hard assets that the company has invested in, the transmission and distribution system, the generation assets, the buildings, and things like that. And in addition, it includes some working capital items, and there are credits for things that monies that the company has received that can offset that, and those items include balance on customer deposits, and deferred income taxes, and then capital grants. Those are the three principal ones that are credited against the assets and the working capital balance. The importance of setting the WACC properly. You don't want to get it too high, and you don't want to get it too low. And the cost of, if you set it too high, electricity prices are higher than they need to be, and that's never a good thing. And eventually that comes around to adverse impacts on both consumers and the economy on the island. So you don't want to go too high. On the other side, if you go too low, that has problems too. It's nice to have low electricity prices, but if the prices result are too low, they're insufficient to adequately fund investment, maintenance, operation of the electric system, which can result in poor system and reliability and availability. You can have insufficient cash flow to pay dividends to investors. For example, Domlec's Social Security system, and there's some private investors own about, those two together own about 42% of the company, and the government owns 52%. So it's important to have some dividends in the foreseeable future. The company hasn't paid dividends in quite some time. And then if prices are too low, that can result in the inability or difficulty to access debt and additional equity investment at competitive rates. So lenders will need a higher interest rate, and if you're looking to attract additional equity capital, they're going to want a higher return. And so you don't want that situation either. And that's of critical importance because accessing new capital when things like Maria happen or things like that is fundamentally a very important thing. And then all those things, poor reliability, bad electric system, dividends not being paid out, and things like that, those things also can have an adverse effect on consumers and the economy in the long term. So the main point of these last two slides is that you want to get a reasonable number that's neither too high nor too low, and so it takes a fair amount of discernment and discipline to strike that balance, and that's why you have a regulator, because it's important. Capital structure piece is the first thing you have to kind of settle on when you're talking about the WACC. And for the study, the 2022 year-ending balances were used in the study, and equity was 90.7 million EC dollars at that point, and the debt, that's debt and preferred equity is just another form of debt, so you can ignore that. Domlec does not have any preferred stock preferred bonds out there, so it's just debt for Domlec, and that balance was 79 million EC, where for a total rate base of 169.7 million EC. And those numbers just fall into the bottom categories of 53.4% of the capital structure was equity, 46.6% was debt, totaling 100%. In reviewing this with everybody that's kind of looked at the study so far, nobody had any concerns or difficulty with that. The equity structure of a utility typically falls in that 50 to 55%. If you look at some benchmarking, and Domlec was right in line with that. So there were no difficult issues to work through on that. Everybody kind of accepted these numbers as reasonable. Any questions on the capital structure before I move on? Okay.
No questions.
Okay, good, thank you. The cost of debt, as I mentioned earlier, this is directly observable, and like the capital structure, this slide here looks at the average balances of December 21 and 22 to discern the cost of Domlec debt, and there was no controversy on this either. Most of the debt is at 5%. There's two pieces that are at 4.9%, and the weighted average of that cost turned out to be 5% even. And that's the case. I'm not sure where debt costs are headed in the future. I know interest rates have been a little bit high. There is some hope on the horizon that they might be falling a little bit. So, you know, I think right now, if the last time I asked Domlec the question, I think the cost of new debt was more than 5%. But the existing debt is 5%, and I think you know, that's a good number to use considering the interest rates. Well, first, that's what the debt is actually costing, and if new debt were to be issued, it would probably be, you know, in that same neighborhood. So there was no issues or controversy with that. Okay. Now comes the big onion that we have to unpeel, the cost of equity, which is there is no definitively correct answer on this. So typically, the approach uses two approaches are typically used, and these are actually in the IRC guidelines. One is called the capital asset pricing model, which looks at the variability of stock prices for specific companies against the variability of stock market prices for the market overall, and discerns, you know, if they're less risky, the company is assigned a lower return. If they're more risky, the company is assigned a higher return in the model. I'll get into the actual mechanics of that in a little bit. And then the second method is something called the discounted cash flow, and that approach basically says that the current stock price of the company is equal to the discount of the future cash flows from dividends for that company. And the cost of equity in that model is the discount rate in that discounted cash flow calculation that says the future cash flows are equal to the current stock price. And both models have their pluses and their minuses. They should yield fairly consistent results. Discounted cash flow models, because companies don't have uniform dividend policies, tend to be a little bit more variable from high to low, but on average they should yield a result that's similar to the capital asset pricing model. And the way these things are typically done is you find a peer group of companies that are on an actively traded stock exchange, and you can work the magic in the mathematics and discern what that cost of equity is. For the Caribbean region, unfortunately, there's not a large number of investor-owned utilities. In fact, Domlec is now kind of a hybrid utility. It's kind of half investor-owned, half government-owned, which complicates things a little bit. But in addition to that, the only investor-owned utilities that I'm aware of is the Grand Bahama Power Company, Jamaica Power, Grand Cayman, Barbados Light and Power, and Grenlec down in Grenada, although Grenlec was taken over by the government, so that's kind of in a hybrid situation as well, because their public policy stances. Yes, we've been taken over by the government, but we're going to operate as a private utility, and they're working through the details on that. So that's one issue. There's a small number of companies. The other issue is these companies are either part of a bigger company that is not really super comparable. For example, Grand Bahama Power and Barbados Light Power are both owned by a Canadian company called Emera, which you're probably familiar with because you were used to be owned by Emera. And Emera trades on the Toronto Exchange, but that value is more based on their operations in Nova Scotia and Florida than it is on the two small companies in the Caribbean, so that it's not super comparable. The companies that are traded on stock exchanges, the other problem is the trading is so thin and infrequent that there's insufficient data there to use the techniques. So because of these data problems, basically the approach that is typically taken is you use a peer group of utilities either in Europe, Canada, or the United States, and you filter them as much as you can to maximize comparability with the situation in Dominique in the Caribbean region and other regions of the world. This is the practice, and then typically there's adjustments that need to be made. One is for country risk. Obviously, with events like Maria and having such a small size, an investment in Domlec has a very different risk profile based on its location in Dominique than American Electric Power does, being located in Columbus, Ohio. So that's the country risk is one thing that needs to be adjusted for, and then the other thing that needs to be adjusted for is the size of the company. Domlec is a 15 megawatt, maybe 16 now, megawatt peak company. That's the size of a large customer or a small city block in these other companies. So the risk to Domlec from being so small, those risks can't be played off with other parts of the company. So, and there's finance theory that suggests that smaller companies do face larger relative risk than larger companies. So those two adjustments I made in this study. So working through the comparison group logic, I work with the US data because it's the one I have the most knowledge of and most easy access to. I started with the group of, there's 40 publicly traded investor-owned utilities that are classified as electric utilities. So that's what I started with. I started with all 40 of those, and then I filtered those to make things as comparable as possible. There was a handful of companies that I excluded because they were not primarily electric. There was a company, for example, I don't remember the name of it exactly, in the Pacific Northwest that was classified as an electric utility, but it was roughly 70% a natural gas utility and 30% an electric utility. So there was a handful of those that were excluded for that. In the U.S., there's been a lot of market liberalization. And as a result of that, many companies have sold all their generation assets and have just become distribution companies. So they're no longer vertically integrated. And so you'd be comparing Domlec, which owns both generation, transmission, and distribution, to a company that is either just generation or just distribution. And the risks of those two businesses are very different, and Domlec has elements of both of those in it, but just looking at one, there's a comparability issue. The other issue that we have in the United States is that the New York Power Pool, the Pennsylvania, Jersey, Maryland Power Pool, the New England Power Pool, and ERCOT, which is the Texas market, have fully implemented competition at the retail level, in addition to being mostly not vertically integrated. There are some companies that are vertically integrated, but customers in those jurisdictions are able to choose their electricity supplier, and the suppliers compete with each other for that. So they're not fully regulated. So companies in those power pools were also excluded because they have a very different kind of risk profile. This was just a kind of a arbitrary, well, not arbitrary, but there's some logic to it, but there are some companies, even by US standards, that are just massive in size. Duke Energy, American Electric Power, North NextEra, which is Florida Power and Lights. There's about 4 or so of those companies that are just so massively large that they were just excluded because they're just really not that comparable. And then there was one company, it's Detroit Edison, I can tell you which one, that I excluded because the city of Detroit is a very different animal than your typical electric utility. Everything's underground. All the load is within, probably 3 square miles of the center, and it's just a different type of animal. Now, Con Edison in New York would have also been excluded for this, but they were excluded because of bullet number 2. And these are the companies that, after all that filtering, we wound up with 13 companies, which is a decent number to benchmark. You get good results. One is Elite, which operates in the Wisconsin area. Alliant Energy, which is in the Pacific Northwest. Avista, I believe, is also in Wisconsin. Black Hills Corporation is in South Dakota. Hawaiian Electric passed through the filters, and that's good because they're an island-based utility. CMS Energy, I think they're very multi-state. IDACorp is in Idaho. Oklahoma Gas and Electric is in Oklahoma. Ottertail Power is in Minnesota and North Dakota. Pinnacle West Corporation is in Arizona. P&M Resources in New Mexico. Portland General Electric Company is in Oregon, and WEC Energy Corporation is in Wisconsin. So those are the peer groups that made it through those 3. Those are the 13 companies that made it through those filters and were used in the study. Now, the capital asset pricing model is typically estimated using that variability in the stock price, and it's basically the cost of equity is equal to the risk-free rate, which is an investment that an investor can make, minus without any risk, virtually assured to get your money back. And that risk-free rate is typically assigned as a U.S. government bond of a term that is representative of the investments that a utility makes. So it's typically a longer term, and the utilities make investments that last 20, 30, sometimes 40, 50 years. So typically a longer term bond is made of that. Plus, this concept of beta, which I'll talk about in a little bit, which is basically the relative variability of the stock price to the market as a whole. Basically, a beta of 1 basically says that the stock's variability is exactly equal to the market's. If a beta is less than 1, it basically says that the stock doesn't vary as much as the market and therefore has less risk. A beta of greater than 1 means that the stock price is more variable than the market as a whole, and therefore has more risk. So that beta is a number that on average equals 1 for stocks, but for utilities it's typically less than 1. Utilities being regulated entities, they have less competition and things like that, so the beta for a utility is typically less than 1. Anyway, that beta is then multiplied times something that's called a market risk premium, and that is equal to the return of the market as a whole. Stocks on average give you this over time. If you had a completely balanced portfolio, you could expect to make X% on the stock market. And typically the index that's used to measure that is the S&P 500 minus that risk-free rate. So basically you'll see if the beta does equal to 1, that cost of equity just collapses to the return on the S&P 500. If it's less than 1, the return is less than the return on the S&P 500. If it's greater than 1, it's greater than the S&P 500. Any questions on that? Okay.
Mr. Vinod, we will have a question and answer segment following your presentation, following you and IRC's presentation. So you can go right ahead and present. Afterwards, we will take questions from stakeholders.
I'm not making out what you said. I apologize. The audio on my end is very muffled.
Okay. Continue your presentation. After your presentation, there will be an opportunity for stakeholders to ask questions.
Okay. The CAPM risk-free rate, as I mentioned, is usually considered to be the return associated with a U.S. government bond with a term consistent with the investment being considered. Utility regulatory proceedings typically will use a 30-year bond, although some prefer shorter-term bonds. The average of the 30-year U.S. government bond for the 6 months ending May 2023, when this study was kind of finalized, was 3.74. Recently, the 30-year bond is now up around 4%, so this study will give, using current rates, would give a slightly higher number, but it would just be slightly higher. One of the things that typically get talked about in these things is whether you should use a 10-year bond, a 20-year bond, or a 30-year bond. We had the good fortune when this study was coming together that the yield curve was close to being inverted at this point. So the choice of 10, 20, or 30 was largely an academic one without any material impact on the results. The total market return. Now this was a topic of some debate. The long-term historical averages are the accepted norm for CAPM in the U.S. anyway. Short-term averages have some downsides in that they're very volatile. If you're doing rate proceedings, 1 year the forecasted return could be 7%. The next time it could be 15%. And if you use short-term numbers, you can get some choppiness from one rate case to the next rate case, and having some stability in that revenue requirement does have some advantages. The long-term average of the S&P 500 from 26 through 22 year to date is 12.01%, and it's pretty much been right around 12% for quite a long time. You'll notice that somewhere around 1960 it settles in at 12%. It doesn't move that much. This period here was the Great Depression and World War II. After that, it's kind of settled in at 12% is kind of the number. It might be 11.7 one year, 12.2 next, and you have big years and down years. So choosing that average is, you can see where if you choose a forecast and that forecast is wrong, you can get a result that could be way off, too high or too low. Now the beta estimate, this is where the complex math starts to come in. The beta is basically the covariance, which is a big fancy word, of RS, which is the stock in question, and which is the return of the stock in question, and then the return of the S&P 500 divided by the variance of the S&P 500. So it's the covariance of the stock price of the S&P 500 divided by the total variance of the S&P 500. Beta estimates from published sources are available, but each source has its own set of issues and challenges that are not necessarily ideal for a utility process, including sample sizes that are pretty small because many of these sources aggregate their data to using just monthly or weekly frequencies. Most of them use monthly numbers when they're calculating the betas, and there's some issues with using month-ending numbers, particularly especially in the U.S. in December and November. We have two major holidays, and the markets can be a little bit funky on those 2 months. So 2 of the months can skew the numbers a little bit, although probably not a ton. A lot of them also use time periods that are relatively short. Most of the published sources use betas that are calculated with monthly data over a 5-year period. So they're estimating the beta with just 60 data points for each company, which is fine if the issue with these companies, and I get why they do it, is they're looking to give investors some general guidance. They're not looking to set electricity prices, and they are calculating these betas for thousands of companies and republishing it every single month. So the beta estimate, unless you have a really big supercomputer, which maybe they'll work to that, but even so, it's just a large undertaking. The other thing about the companies is they make ad hoc adjustments which may or may not be appropriate for regulatory proceeding. For example, Morningstar takes the beta and they take a weighted average of the calculated beta and 1 to what they're saying is they want to eliminate outliers, both high and low. But what happens is and this is particularly problematic for utilities, if your beta is less than 1, the Morningstar adjustment will move the beta higher than the actual data would indicate, and resulting in higher prices. So that's just one example of an ad hoc adjustment made by companies that may not be appropriate. And every company also uses, well, most of them use the S&P 500, but some of them use a broader index. Some of them use the Dow Jones Industrial Index, so you're not really sure what you're getting unless you really dig into the details of their calculations and how they get it. For purposes of this study, I downloaded 10 years of daily stock market data through September of 2022. So I've got what's figure there's roughly 2,000 trading days in a year times. So I've got 20,000 data points for each of the stocks that I use to calculate the betas. And for the peer group, these are the betas that came out of that analysis. They range from a low of 0.51 for Wisconsin Energy to a high of 0.89 for Otter Tail Power, and for an average of 0.66. So that 0.66 is what I used in the study. Most of the studies I've seen done in the U.S. in regulatory proceedings, that number is very close to 0.7. So this is actually a little on the low side. So what I did is using 12.1% as the market return, 3.74% as the risk-free rate, and the betas on that page, these are the resulting unadjusted. These do not include country risk adjustment or company size adjustment yet. These are the estimated cost of equity for the 13 companies in the peer group. The average of that was 9.17%, a max of 11.05%, a minimum of 8.5% first quartile breakout of 8.55, and a third quartile of 9.62. So half of the numbers fell between 8.55% and 9.62%. The discounted cash flow model, this is a fancy math thing that basically says today's stock price is equal to the future stream of dividends, basically the dividend in this year out to infinity of discounted by this thing called K, which would be the discount rate that make that expression true. And that K is the discount rate, and that would be the cost of equity. There is a formulation of that which is called the constant growth model, which I did not use. It's a much simpler way to do it. It basically collapses to the discounted cash flow. Cost of equity is equal to today's dividend rate plus the future constant growth rate for the company. So example, if a company had a current dividend rate of 5% and its growth rate was that those dividends would increase 5% annually ad infinitum, the cost of equity in that situation would be 10%. It's just the sum of those two numbers. That, in my opinion, given that we have a lot of information from investment houses and short-term forecasts for these companies, is a bit simplistic. I prefer to do something called a two-stage discounted cash flow calculation. And basically what I do is I take the current stock price, and what I did is I took the most recent 2-week period. Just if you pick one day, stocks do weird things on one day, on a single day sometimes. So that 2-week just kind of averages out any short-term noisiness in the data. And then on the investment houses, Merrill Lynch, Citibank, all those people, they have people that just research these companies and issue forecasts for them that investors take very seriously. So what I did is I took from the forecasts that are available, the 1-year forecasted earnings growth rate for year 1, and then for years 2 through 6, they had a 5-year, there's a 5-year forecasted growth rate for the next 5 years that's available. And then beyond that, for the long-term growth rate, rather than take a forecast, I basically said anybody that thinks they can forecast beyond 5 years is maybe they're right, but maybe they're wrong. And a more reasonable approach, in my mind, is to look at the last 10 years of dividend growth for the company and say, okay, the last 10 years should be some guide as to as to what the future holds long-term. So what I did is I took the dividend level in September of 22, compared it to the dividend level for the company in September 2012, and calculated the cumulative average growth rate that those two numbers imply. This is a big, ugly formula that says this is what the two-stage growth rate means, and basically what needs to be done is these need to be operationalized, and then there's a function in Excel that basically says you can iterate towards the discount rate that makes that true. And these were the stock prices, the current annual dividend, and the consensus growth forecast for the companies at the point I did this study. So, for example, I'm just going to do one elite. The average stock price was $55.23 US. The annual dividend was $2.60. The consensus growth rate for year one for the company was 4.5%. The consensus growth rate for years 2 through 6 was 8.7%. And then the 10-year historical growth rate was 3.5%. And so that's just one example. And then operationalizing those with the magic of mathematics and a very powerful spreadsheet, basically came up with cost of capital estimates for the two-stage model with a minimum of 4.85%. And again, these are unadjusted for Hawaiian Electric, a maximum of 12.64% for Wisconsin Energy, and first and third quartile breakouts of 8.3 and 10.82% return on equity. So 50% of the numbers using this method fell between the numbers of 8.3% and 10.82%. After you go through all the math, there's a few tests for reasonableness that are typically applied. Number one being, do the CAPM and the DCF yield similar results? If they don't, if the results are inconsistent with each other, that calls into question either one or both of the approaches. Something is amiss in the data. And then secondly, are these results consistent with the jurisdictions reached in other regulatory jurisdictions? I took just a simple average. I weighted them 50-50, and I came up with a weighted average. You'll notice that the results are consistent. The average of one is 9.17. The average of the other was 9.19. Extremely consistent. I just took the simple average and used 9.18% as the average. Now, this is a range. You're free, the commissions typically look at these studies and look at ranges and say, okay, we're going to set it within this range or that range, and this is the number we're going to choose. But on the first test of reasonableness, it passes with flying colors. Very, very consistent results. Being that these are unadjusted results, they should give results that are pretty consistent with recent U.S.-Canadian ROE decisions. Now, I just picked the most recent year. This was not in the study. I pulled these numbers last week to see where returns were. These are not the numbers the companies filed. These are the numbers that the commission decided what would be granted. So very quickly, Alberta Electric Utilities in Canada was recently awarded a 9% cost of equity. Nova Scotia Power was awarded a 9% on cost of equity. Maritime Electric Company was issued in Prince Edward Island, was issued a 9.35% return on equity. Fortis in British Columbia was awarded a 9.8% return on equity. Encore in Texas was issued a 9.7%. Xcel Energy in Minnesota was awarded 9.25%. Arizona Public Service, 8.9%. Duke Energy in South Carolina jurisdiction was ordered 9.6%. Alliance Energy was awarded 9%. Madison Gas and Electric in Wisconsin was awarded 9.7%. Xcel Energy in Wisconsin was awarded 9.8%. United Illuminating in Connecticut was awarded 10.2%. Appalachian Power in Virginia was awarded 9.5%. And the average of the decisions that I was able to find for 2023, and I had one data point in 2024, that average is 9.45%. So it's pretty much consistent with the 9.18% unadjusted that I had estimated, very much in the same zip code. What this graph does here is it lays out by quartile the ranges of the CAPM study, second line down, the discounted cash flow results, third line down. The top line is the average of those two, and then the bottom line is the distribution of the 2023 and 2024 decisions that were awarded. And you'll see that the gray and I guess that's kind of a yellowish orange. I'm not sure. I'm not an artist, so maybe someone can tell me what the hue is of that. But that burnt yellow bar is the middle 50% of those ranges, and you can see there's a great deal of consistency across this and actual on-the-ground results that were awarded. In fact, the 9.18% is well below is about 50%, 50 basis points below the average of recent decisions. So that's where we landed for the cost of equity for CAPM and then DCF unadjusted. And talking about risk adjustments, typically risk adjustments can be done two ways. One is the sovereign debt cost versus the equivalent U.S. debt cost, which is the approach we took. The other is to look at credit ratings of companies, and unfortunately Dominica does not have an assigned credit rating by S&P or Fitch or Moody's. So if we were to go that route, we would have to choose someone to serve as a proxy, maybe Barbados or someone like that. But being that we have data on bond issuances from Dominica, we decided to go that route. We could have used more bonds, but they all pretty much yielded very similar results, so we just used the most recent Dominica bond that was issued. Maybe there's been one since then, but at that time it was issued in November of 2022. The country issued a 7-year note at a cost of 7%. Now the equivalent U.S. government bond cost on the same day of November 18th, 2022 was 3.92%, which implies a 3.08% company risk adjustment that would get added to the member for the country risk. And in dialogue with the IRC and their consultant, they pretty much agreed that this was a reasonable estimate of that country risk adjustment. Company size adjustment, we did not have agreement, but so that was pretty much sidelined, but I'm going to go through it anyway, because I do think it is something that should have been considered, and it is valid. Domlec is microscopic in size compared to U.S. utilities in the comparison group. Compared to the U.S. utilities in the comparison group and U.S. public utilities in general, smaller companies are riskier. Some adjustment to the ROE to account for this difference in size is warranted. Typically, that beta that we talked about earlier captures a lot. Not 100%, but it captures a lot of the risk inherent in companies. So the approach I took was to look at the betas for the peer group relative to company sizes, and if you look at a scatter plot of the betas versus company size, and I used plant investment as a proxy for size. Every measure you choose has issues. This seems to be the least issue-laden one that I could think of. You could go with kilowatt hours, but there's some companies that don't have a lot of kilowatt hours, and they have a massive company that has a very low profile, and they have to build a lot of plant for it, versus companies that have a lot of kilowatt hours because they got a bunch of really small customers and no big ones. So that's an issue. Number of customers has issues. Market capitalization has issues because of the mix of debt and equity, and and other things that confound that number. So I went into the balance sheets of the companies and said, okay, what do all utilities have in common? They all have to invest in plants. And this scatter plot shows indeed that the smaller companies in the peer group absolutely had higher betas than the larger companies in the peer group. And that equation that the beta is equal to 0.75 minus 0.92 times the investment in plant measured in billions of US dollars has a pretty decent fit. So basically the approach, you need to basically kind of say, okay, given Domlec's size, which would be way over here, very close to the zero line, the beta should be upward adjusted a little bit, and combining that with the market risk profile in there indicates that a company size adjustment of 79 basis points would be appropriate for Domlec. So all those three numbers, the 9.18% plus the country risk adjustment of 3.08%, and then the small company size adjustment of 0.079%. Total, in the study I conducted, that the appropriate cost of equity for Domlec would be 13.05%. Reasonable people can reasonably disagree, especially over things that are subject to interpretation and statistical variations and other things. So we worked with the IRC and their consultants to kind of narrow down differences. They had a result that was their initial result was very, very different. But there were some areas where we worked together and narrowed our differences, and these next few slides kind of walk through where that narrowing your differences landed. The IRC had a number of suggested revisions that Domlec and their board has reviewed and agreed to. Specifically, the ROA should be based on a CAPM formulation where the market risk premium is based more on a more short-term and broader market index. So the risk premium that was suggested was much smaller. And then the other major adjustment that was suggested is that the beta estimates should be adjusted for the mixture of debt and equity in the capital structure. So that adjustment was done. The company size adjustment was rejected. And after all of those revisions, this resulted in a post-tax adjusted ROE of 10.51% versus the 13.05%. So it fell by 250 basis points approximately. The adjusted results in terms of where things landed. Now these are adjusted with the country risk and the company size adjustment. And I've also, just for relevance and comparison benefits, also listed the three recent decisions that I was able to find data on in the region. So the Domlec study on the far right was the 13.05. The IRC I don't know what to call it, resolution or mediated result was 10.51%. The initial, that compares with a result, very close to a result in Jamaica of 10.78%, 11.75% in Barbados in 2023, and Grand Bahama in 2021 of 12.84%. So we've landed at very much on the low end of the range, but it is within the range. So I think it's not a it's a pretty good result in my opinion. Especially there's a few issues that really factor into this. One is Domlec is not typical anymore with its 52% of ownership by government. It's really kind of a hybrid, and so the comparison with a purely investor-owned utility is still valid, but it's a little bit blurred. And publicly owned companies typically, profits are not their key drivers. So something on the low end is not that surprising. And the other thing is, Domlec is very concerned about affordability, and kind of accepting something on the low end of the range is something the board is agreeable to. And all of these results that boil down to what was presented in the consultation document basically showed that the cost of equity, I've got it broken out by the three tranches at government, Social Security, and private investors. Each of those at a 10.51%, debt at the 5%, and then doing the weighted average that comes with an after-tax, results in an after-tax weighted average cost of capital of 7.95%, and then accounting for the income taxes that must be paid on the equity proportion, that increases the WACC to 9.82%. That concludes my prepared remarks, and I'm happy to answer any questions, although hopefully they can either be sent to me via typing or the microphone can be moved to whoever's asking it, because I am really having a difficult understanding the audio.
Thank you, Mr. Binaj, for your presentation, very comprehensive and detailed, I hope. Please stay on the line, Mr. Binaj.
Yeah, I will stay on the line for sure, yeah.
Yes.
I'm gonna turn the sharing off.
Yes, thank you very much.
For some reason, I can't see the questions when I'm sharing my screen. I don't know why, but...
Okay. Tech support, please mute him. Thank you so much. So next on our program is IRC's presentation, and I would like to invite Mrs. Connie Joseph Louis, IRC's financial statement, to do that honor. Mrs. Louis is responsible for examining Domlec's financial statements. Part of her role is to ascertain Domlec's financial health for a cost-effective service. Mrs. Louis, your turn is next.
Okay, I am not going to be too long. because Mr. Vinaj provided an overview of the weighted average cost of capital and the entire methodology that surrounds getting the end results. So I'm just going directly into what the IRC did. As you know, we are guided by the Electricity Supply Act, and it provides us with the autonomy to perform our duty independently and to have a due regard for the public interest. We also have other important documents like the license, the transmission and distribution and supply license, the generation license, and the tariff regime document that guide our process. As part of the weighted average cost of capital, we contracted the service of a regulatory consultant, and for PIA, who conducted a comprehensive review of the IRC's work on the WACC. Initially, as was said, we had already done a depreciation study that was a few months ago, and now we are working on the approval of the weighted average cost of capital. In simple terms, the weighted average cost of capital, just to explore, because we have persons who are listening to us via Emonews, for instance, it is used to derive the rate of return investors receive from their investment in a financial company. So, for instance, we know that in small communities we may have small shops, and we may fund the shop either by taking a small loan or either by using our personal funds to buy our grocery item to ensure that the shop is run. Annually, we want to ensure that our shop is going on successfully profitable, and therefore we want to get a return. So in a nutshell, that is what the weighted average cost of capital allows for. It allows the investor or the shareholder to receive a return or like a profit based on the investment that have been made. And same applies to Domlec. Domlec invests heavily in assets like the generation asset, transmission and distribution asset, building, motor vehicle, just to name a few, to supply electricity to the end users. Now shareholders invested in that to ensure that electricity is provided to customers. So part of the capital structure is, as we said, they may take a loan, and persons might put in their own personal funds to buy shares into the company, for instance. Hence, that is the capital structure. If we go further, we have the WACC formula. Of course, Bill presented it, and in the WACC formula, it determines the method at which that rate of return is calculated. Okay, so we are seeing therefore a fraction of the company's cost of the company's debt, a fraction of the company's equity, and all that is multiplied by the cost of debt or by the cost of equity. As the previous Mr. Vinash said, in simple terms, the cost of debt, more or less, is the interest rate on the loan. And in Domlec's determination, they provided to us what the capital structure is made up of. The Commission, as part of our comprehensive review, we looked at Domlec capital structure of debt of equity as noted on Domlec's annual report for December 2022. And this is shown on page 16 of the consultative document which you have in your possession. At the time of doing the WACC study in mid of 2023, The only annual report that was available was that of 2022 and prior years. So, but thereafter, when the 2023 annual report was presented, the Commission further used the financial information of debt of equity for 2023, and we compare whether the debt fell within the same range as that of 2021 and 2022. So here we are seeing the gearing ratio of 46% and 46.49% in 2022 and 2021, 47.69%. When we computed those for 2023, we saw that it fell within the value of 46.8%. It should be shown in the slide, as we can see. So we all agree, both IMC and of course Domlec, that the debt fell within the same range, both for 2021, 2022, and 2023, based on Domlec annual reports. Further, the Commission, as presented in the consultative document and as presented by Bill, we also assess the debt level of that of other utility companies within the region, and we also assess or verify the correctness of the equity component. Remember, we said the capital structure is debt on equity. So within the region, what we found that for some of the utility, the debt averaged 40% and the equity averaged 58%. It's shown on the next slide. Okay, so we saw that Domlec falls within the same range of that of comparable companies in the region, and these were Jamaica Public Service, that's JPS, Greenlec, the Caribbean Utility Company, that's in Grand Cayman, and Bermuda. So we verified based on the most recent information that was available at the time. In case of the debt component now, as we said, it's straightforward, it's interest on their loans. So Mr. Vinaj and I also presented the slides showing Domlec's debts. They have debt, which is their loan that they took from National Bank of Dominica, and also the loan taken from the Caribbean Development Bank. And on average, we have an effective interest rate of 5%, and Mr. Vinaj already expounded about it. So that cost of debt, which is 5%, would be multiplied by the fraction of the cost of debt for Domlec, which range about 46%. Therefore, we move on to the cost of equity. And now the cost of equity is more comprehensive. It's a lot of financial and accounting terminology that some of us may not be familiar with. Some of us who are involved in the financing or economic background would have a clearer understanding, but ordinary folks, it might be rather challenging. So some of the terms might be challenging for the ordinary folks. But anyhow, this is something that we must go through because the process allows us. Now, general or worldwide standard accept two methodologies for calculating the cost of equity. And Mr. Vinaj spoke about it. I also presented slides about it, but I will just go directly into what the IRC did. So we, of course, the approach to calculate the cost of equity is, we heard about the risk-free rate, which capture an investment with zero risk. We heard about beta, which look at the systematic risk relative to the market. We look at the market risk premium, which is additional risk paid to the investor for investing in risky assets. So all that is used in determining the cost of equity. There's another methodology that it was also spoken about, which is the discounted cash flow. So I'm just going straight into what the IRC did. So Domlec submitted their proposal to the IRC. And then the IRC, so for example, they proposed a risk-free rate of 3.74%. The Commission reviewed Domlec's proposed risk-free rate, and as he said that it was based on the 30-year U.S. Treasury bond from December 2022 to May 2023, and it is shown on page 19 of the consultative document, that is Domlec's consultant proposal. Then, based on IRC review, IRC provide a risk-free rate slightly different from that of Domlec, 3.75%. And why we chose that? We found that based on the data set used, published by as at July 19, 2023, we used the 6-month average of US 10-year Treasury bill. And we felt that it was more recent information. So those of Domlec was shown over a 30-year Treasury bill and captured the period December 2022 to May 2023. Ours, we use published data, which is also available. We use US Treasury bond based on July 19, 2023. And it's based on, as I said, on the 10-year Treasury bond. Domlec was of the view that they choose the 30-year because some of the assets has a useful life of 30 years. But we felt that some of the assets that are in, that Domlec also uses, have a average life of have average life of 10 years as well. And what we found within the region is that some of them use 10 years, some use 20 years, but what we found that one showing 3.75%, one showing 3.74%, it's not that skewed. So that is why the IRC proposed the 3.75%. Now we spoke about beta and the level, and beta is simply we look at the level of risk and to the company versus the risk to the market. So Domlec proposed a level beta. So as the level beta uses risk associated with both debt and equity in the firm's capital structure. Domlec proposed a beta using 10-year of daily stock price and the return from S&P 500. I'm using 13 comparable U.S. company. And this company is used as a proxy for Domlec. And it is shown on page 26 of the consultative document. The Commission reviewed and analyzed Domlec's data. And the Commission, based on its first discussion, we also had collaborative discussion to settle different tranches as part of the tariff of the WACC process. So we had an adjusted unlevered beta. So the unlevered beta more or less takes off the debt component, and it more or less look at the equity. It's like how much equity financing contributes to the company's risk. And after through much discussion, we arrived at the Commission proposed an unlevered beta of 0.44% using 5-year average of all U.S. electric companies published by one of the financial professor. I think he's a professor. He's Aswath Damodaran. I do not know if you all heard about him, but he published financial data. So we use the data published by him as of January 2023. And of course, his work is also used by other regulators, such as in our research we saw that JPS use it, that's Jamaica Public Electricity Company, JPS. We saw that Fair Trade Commission also use their data. So these are published financial data sets that can be used for comparability or from benchmarking purposes. The Commission felt that the unlevered beta is more accurate measure to look at the volatility and performance of investment company relative to the overall market. So the Commission considered that all U.S. electric company is best used for benchmarking as for Domlec, as a proxy company to Domlec. And we note that there is no exact U.S. company that is comparable to Domlec in terms of size and valuation. So hence the reason we use the all U.S. company beta of 0.44. And also what we found when Mr. Bill spoke about if you have a beta of 1 and if you have a beta of less than 1, we saw that Domlec beta is more or less than 1 because it's a monopoly, it's the only utility company, there's no level of competition. So the level of risk is not as high as compared to other companies where there's competition in the sector. In terms of, we heard of the word market risk premium, and that is also found as part of using the CAPM model or CAPM methodology. And Domlec proposed a market risk premium of 8.27%. The market risk premium, one method, is where you use the expected market return and you subtract the risk-free rate. However, the Commission also reviewed the data sets provided by Domlec. And the Commission, after reviewing the data published by Domlec, which they use S&P 500 index from 1920, which published data from 1926 through 2022, the Commission proposed a market risk premium relative to bonds of 5.06% based on the financial data published by Professor Damodaran, which provides data from 1928 to 2022. So that information was published as of August 1st, 2023, and it is shown on page 24 of your consultative document. So the market risk premium used was 5.06%. Now, the Commission note, and I spoke about it, that part of the research, we more or less kind of liaise and do research in terms of what similar type company use. And we, of course, we are in the region, we have other players in the region. When I talk about players, we look at other work performed by other regulators, that's the Office of Utility Regulation in Jamaica, and also Fair Trading Commission in Grenada, and they use the same data set as IRC is recommending. And of course, we went through the number of data sets used by Domlec, S&P 500, we went through it. We, of course, also use Router in assessing the beta value. We also evaluated the U.S. Stock Exchange in terms of the comparable 13 companies that Domlec used, and we felt that our proposal would be equitable in allowing Domlec to operate smoothly and also looking at the impact of the rates on the consumers. We also looked at Domlec's, the other methodology used by Domlec, and of course it's part of the IRC's, the regulatory policies guided by the Commission to use the discounted cash flow model. And based on the discounting cash flow model, Mr. Vinod spoke about it. The formula is there as well. they use the dividends, look at the future growth, and with all that is taken into consideration. And what we found that, using the CAPM model, Domlec arrived at an average of 9.17% using CAPM methodology. Using the discounted cash flow, they arrive at 9.19%. So there is no significant variance. And using the average as recommended by IRS, as stated in IRC's tariff review, there is a weighted average using the two methodology of 9.11%. Then, thereafter, we had a series of discussion. We concluded on a WACC following discussion between both IRCs and Domlec, looking at IRC's adjustment in terms of the beta formula, in terms of the market risk premium. We agreed upon the capital structure. We agreed upon the country risk premium. It is also shown in the slide. So after review, the Commission also agreed on it. And at the end of the exercise, the Commission proposed a pre-tax WACC of 9.82% and a post-tax of 7.90%. Domlec proposes a pre-tax of 11.63% and a post-tax of 9.3%. In a nutshell, this concludes my presentation, and the discussion is open in terms of the consultative question, whether based on your view, you accept the IRC's proposed rate of 9.82% pre-tax and post-tax. We accept IRC's post-WACC of 7.90%. Whether, as part of the stakeholder, we accept Domlec's proposed pre-WACC of 11.63% and the post-tax WACC of 9.3%. Hence, the conclusion of my presentation. We are of the view at the IRC that the 9.82% WACC is quite reasonable for Domlec, and therefore we want to have a transparent process. We do not want to say that it's IRC's decision. We want to say that the citizenry, the citizens of Dominica, had a stake in making that determination. Hence, the need for having that consultation even online, hence hearing your feedback, hence hearing what we have a 2 weeks waiting period to see if persons will review the consultative document, will submit their responses to the IRC and help IRC make a decision. Because we do not want to say, oh, this is IRC's decision to provide a WACC of 9.82%, or this is IRC's decision to allow Domlec to lose the 11.63%. And therefore, we all have concern how this is going to impact on our rates. So I just, that's the end of my presentation as concluded. We had thorough discussion, and we did it in a transparent way. Domlec had the consultant, IRC had its own consultant. We, of course, worked with our team, and we are here to present our findings based on the work done. Thank you.
Thank you, Mrs. Lee. We have come to the point where we will invite Ms. Tioka Dove. She's the lead for capacity development, collaboration, and communication for the USAID Energy Sector Reform Project. So she will moderate the question and answer segment on behalf of IRC. The floor is open. Let's go.
Good morning, everyone. First off, I want to thank you all for being here. and for remaining locked in for the board presentations. Do we have a mic for the audience, or how is it a roving mic? Yes. Okay, I would like that mic actually. So basically, you had two presentations just now, and I really want to ask a very frank question, not to the technocrats in the room, but members of the general public. Did you understand what was presented in its entirety? And what did you not understand and would like addressed? Perfect.
Hi.
Is it on? Just now. Let's try again. 1, 2, 3, 4. Okay.
Hi, my name is Rhea Williams with Domlec Hotel and Tourism Association. So what I'm trying to understand in the end is what is going to be the actual cost of borrowing for Domlec at the end. Lots of numbers were thrown around, so what I want to understand is what actually is factored into the into the WACC. Okay, so is the base rate 5%, or is it the treasury of 3.75% plus an index, which would include the country risk rate of 3.08 plus the equity risk premium of 5.06 plus an additional index. So that's really what I'm trying to understand.
I would hand over to a colleague to answer your question.
So as indicated, that would have been the WACC methodology. The WACC methodology is the cost of equities, what you need. But it is that component, that methodology, the borrowing will remain at 5% or whatever interest rate based on the loans taken by the institution, because commercial banks, CDB have their own rates. So the borrowing part, the interest rate is separate and apart from that. However, the rate of return, the WACC, the cost of debt, you have the 5% debt, and the rate of return, the cost of equity, is a portion, the 10.51% that he was referring to. Once that component will allow Domlec to get a return. So in a nutshell, it factors two things: the debt component and the equity component, which will allow them to get that return. So their borrowing rate is based on the term of the loan. If I defer, I think Domlec official is there, and they could also add on that.
Who's the relevant Domlec official that I give the mic to?
The CFO is
Okay, so is it necessary?
No, I think I understood once you explained it, but when you have something like this as a consultation, you just kind of throw numbers and calculations and formulas all over, it doesn't help the general public at all, right? Because I'm sitting here trying to do the math, as you can see, and I'm like, okay, it doesn't make any sense. Okay? Yeah. So that's one question. The other question is regarding the debt percentage and equity percentage of Domlec. Is it the intent of the IRC to say going forward, any additional borrowing or any additional capital investment that Domlec has to do, then the ratios to debt to equity for the business needs to remain at those levels? So if they need to borrow $10 million, for example, then 53% of it needs to come from equity investment via either share sales or bond issuance, and the remaining finance. Like, what's the need for that?
That's a very good question. But IRC, we are not managing Domlec. IRC, we are not managing Domlec. However, what we hope, what we are of the view that when Domlec is seeking investment opportunity, they look at the level, they look at the WACC methodology, the cost of borrowing they agreed on. So it's their purview or their view in part as part of the negotiation with the bank or commercial bank or other lenders to try to ensure that they fit into that, because each of the borrowing we saw, some of them attracted different interest rates. Some of them had 4.5%, some of them were at 5%. So the 5% more or less is an average, is an effective interest rate. So we are hoping that Domlec will not go out of that, because if they go out of that range, it might affect their bottom line.
Thank you very much. Please state your name and the organization you represent.
Good morning still, or it's still morning? My name is Ian Dorival. I am a finance professional, and I do not represent any organization now, but the consumers. What I must say though is that I got the information, I got ample time to review it. It was a very academic exercise. And as a finance professional, I understood it, but I had to go back to my ACCA days when they taught that. But to be honest, I totally agree with IRC that I read each of the different with their recommendation. And basically, I have some questions regarding beta. Beta is now, most of the people listening about beta will not really understand. It basically says that if the average investment portfolio moves by a certain percentage, whether the company will move in the same percentage, or whether it will move to a certain degree. But I'm not too sure if when this exercise was being done, whether they took into consideration the fact that Domlec is in fact a monopoly, and even if investment changes by a certain percentage, it hardly will impact Domlec changing in terms of their. So if it's that the market drop by 30%, I don't think Domlec is going to change by 30%. A lot of the analysis was done in the US market, which is very, very mature market and very, in terms of things happen, if certain things happen, it changes, and we use those to get to calculate it better. I don't know if that was the correct methodologies to use, and a lot of the business, for example, in the US market are very competitive, and also much larger than Domlec. So I also look at the situation of the island risk and the company risk, where the country risk, as the gentleman mentioned, that we are risky in terms of hurricanes, and if we have a hurricane a year, this changes the profitability and so forth in terms of operation for Domlec. But in terms of the company risk, I do not believe Domlec as a company. Sorry about that. I do not believe Domlec as a company has the level of risk to warrant the risk premium that was used to calculate the WACC. No, this calculation, and I have to ask a broad question. With this rate reviews, is based on all this calculation, are we going to see an increase in pricing from Domlec? And this is what all the consumers want to know about. And on the bottom line, and all this fancy calculation of this, because those are numbers. If you adjust those numbers, we can either bring down the rates or increase the rates. So we must take that into consideration, and we must understand that Domlec is operated in a monopoly, and the risk premium and beta being used to adjust those prices are really geared towards making a better pricing to the consumer, or a higher pricing to the consumer.
Thank you very much. 1 second. So just for context, we will go through the 8 consultation questions following. I just want to give the room the opportunity to ask their personal questions. Yeah, so we still have to go through the consultation questions thereafter, but everyone in the room will have a chance following the presentations to ask their questions. Please go ahead.
Yeah, just some clarification I wanted.
Sure.
For doing the CAPM, the IRC and Domlec use different proxy companies, isn't that correct?
Yes.
Okay.
Yes.
When it comes for the discounted flow method, did you all use the same sort of companies to come to that?
No. We spent, worldwide, we know of the CAPM methodology, and we went thorough into the CAPM methodology. And when we review the data set provided by Domlec, and we saw that the number was as close as the result provided by the CAPM, we went with it. So part of the all US company are the 13 companies which is used in the discounted cash flow method feeds into the all US company. So they are part of the all US company. So the 13 companies, as I said, that is used in the discounted cash flow method is factored in the all US company. And when we go through it, verify the figures, we saw that it was in sync with the CAPM methodology. What we also found that as part of our research, most regulators go with the CAPM methodology, but our tariff regime document requires us to use both methodology, and we saw, as was presented, that when we averaged the two, they were in sync.
Okay, so if you had used the same the same proxy companies, when you did the CAPM, you may have come with a different result, no? No.
Not necessarily.
Okay, no.
Okay, so Mr. Case asked to make a contribution. I'm going to let him make a contribution before I go to the next question.
Okay, I would like to respond.
And then I'll come to you thereafter, right?
Yeah, I'd like to respond to the first part of Mr. Dorival's question. Domlec is not entirely a monopoly. They have 2 licenses. One is the transmission and distribution is exclusive. The generation is non-exclusive. So within the market, room is open for competition in the generation area. So that's where the risk to Domlec really is at this point in time. As you are aware, the government is pursuing the development of a geothermal plant, and they will be taking up a significant chunk of the generation that Domlec would have been doing in the near future. And as for the risk, I'll allow Mrs. Wu to respond to that.
Okay, just to factor, when Domlec proposed their beta value, they proposed a higher beta value of 0.66. When IRC proposed the figure, we brought down the figure, or we proposed a figure much lower, 0.44. We take into consideration that Domlec is the only utility company operating in Dominica. We, of course, as Mr. Case noted, that it is not, in terms of the part of the license, the generation license is open, so anybody can generate electricity. So we note that level of concern. But we did not propose or accept more or less the figure proposed by Domlec. We went with a lower figure. And within the region, we know of the Eastern Caribbean Stock Exchange, ECSC, but it is not a mature market. And you do not have much data set that you can use for benchmarking. In 2014, we had a period of a tariff review period, and we went with the ECSC figures, and then we had to go back to the drawing board because what we found that it was not in sync with those applied by other regulators within the industry. From an academic standpoint, from a theoretical standpoint, from a financial standpoint, the data set captured by Matthew markets are widely used by economists and financial personnel within the sector. Hence, our reason for hinging on the Matthew markets, because it provides a better base for benchmarking the indicators.
Thank you very much. You can go ahead with your question.
Thank you. My name is Vanya David. I'm representing National Council of Women, and so thanks for having us here. Just some clarification. In your preamble, Mrs. Lewis, did I hear you say the cost of the debt is the cost of interest on the loan? Can you clarify that, please?
Debt is loan, it's borrowing. So if I want a loan, I go to National Bank, I take a loan of $5,000. That is the debt, that is the borrowing. They will tell me I need to pay interest on that. So the interest rate, they might tell me, okay, for you to take that loan, you need to pay 5% interest per annum. So with a borrowing, there is a level of interest. So the interest is the payment is the charge, more or less, applied to the financial institution. So it's like it will be revenue to the financial institution, but it is an expense to the borrower. So the interest on loan is applied to the debt component of Domlec capital structure. As we said, it is made up of debt, which is what we borrow, and it's made up of equity, is what the investors contribute in terms of shares and so on.
Thank you.
Thank you, Perez. I'd like to interrupt a little bit. Going back to Mr. Dorival, I didn't want to overlook his last question. He mentioned that in the final analysis, everyone is concerned as to whether the rate will go up or down, and that is usually the position of most people. However, at this point, we have not agreed with Domlec has not concluded on the what we call the critical parameters that feed into the calculation of the rate proposal. The final document will be the rate proposal, which will give us an idea of what to expect in terms of whether the rate increases or decreases. So we are still a little way from that. So we would like to see you on the next, 2 sets of consultations that will be occurring prior to the final submission by Domlec on the rate proposal. So at this point, it will be unjust for us to say it's going to increase or it's going to decrease. So let's bear with us, because ultimately, hopefully, before the end of this year, we will definitely know.
Thank you, Mr. Case.
So one thing I'd like us in the room to appreciate that. Oh, my name is Jason Zimade. I work at the IRC. I'm the project officer. One of the things we need to look at when we're analyzing is the process we're going through right. I know at the end of the day, all of us that I pay a bill to, we really want to know, is our rate going up or is it going down? But I think the reason we ask for professionals like yourselves here is that we want to ensure that the principles we are working on are what really taken into context. The average man on the street wants to know up or down. I expect the average professional to look at the principles and are we operating on the correct principles so that in the long term everything works out better for everybody and not just the short-term gain of my electricity bill goes down next year. So it's more, let's look at the principles that we're working off of. Are you all in support of the principles?
One moment, I'll come back to you just now. This gentleman facilitating a line.
I'm Michael Astafan. I represent several hats, but that is, I don't know. My company is Mariner Enterprises.
Can you put the mic a bit closer?
Yeah, sorry about that. My concern is, as they just mentioned, is how it's going to impact on the cost to the consumer and myself. And I note that as a past member of the board, the factors that we're looking at now had very little impact on rates. What had impact on rates for a utility company is things like what they call gold plating. For instance, IRC has to look carefully at the purchasing of equipment and the cost at which they have purchased that. Okay? Because regardless of the rate that they return on WACC, if the purchasing is not right, done right, because my experience with Domlec, when I served on the board, they were losing money for 3 years. And just by controlling the purchasing and the management of certain critical parts and to ensure that they had the right staff in the right positions, we saw a massive profit increase without any change in the return on investment or so. Okay, so it's important that, you know, whatever we do, and I'm in favor of what the IRC is doing, it is done in a way to preserve not only the consumer getting value for money, but to ensure that Domlec is run efficiently and they can survive. Because who is going to fail in this day? There are several other risks we have to look at. Who is going to survive in this day? Are those persons with the resources to move into alternate energy and run their home? And the poor and middle class who cannot afford will suffer. So it's important that measures are taken in that direction.
Thank you kindly for your contribution, and we would have one more question. You have two more questions, and then we go to the consultation question specifically.
Okay, I'm just following up on a few questions, and just to follow up on Mr. Jason Timothy. On principle, what is being done is the most applicable approach for a situation like that. Now, my question is not whether using the mature market is the appropriate market for that purpose for a company like Domlec in a country like Dominica. The second thing, Mr. Case mentioned that the government is going to do geothermal very soon. That might be another 15 years again. But the issue is the process of moving geothermal, the raw product, to the different households. That's another story. And whether the government is going to do that directly or going to do it via Domlec, because you have to change your whole way of generating those power. It's not simple as taken from a generator. It's going to be a completely different and a very expensive.
Okay.
No, I didn't finish. So the process itself is okay, academic, very much so. But are we guided? Maybe we should have used the Caribbean countries with very limited data because it's more appropriate for our setting. And as Mr. Astafan said, it's how does it impact the consumer is the most important thing going forward.
Thank you. Mr. Casey, you had a
Okay, so
statement?
just to update Mr. Dorival, the geothermal project has already started. The government signed off on the various documents for funding with the investor and all that since November, end of November, early December last year. If you go up to Loda right now, they are grading the thing and grading the area where the plant will be built, and a lot of hardware has already been moved to location. It is being built by a private investor which was chosen to do so. That's one. Our regulations accommodate, our regulations are in place to accommodate power from an IPP. So it will be a direct pass-through, like how the surcharge is being applied, the same basic principle. Okay? Now, in terms of the technical aspect in which you were speaking to and how the power will reach to the consumer, in regulation, within our regulations in Dominica that was adopted for the Dominica situation, we adopted what we call a one buyer, one seller model. So no matter who comes in as an IPP, they will sell, they have to sell their power to Domlec. Okay, so Domlec is the only sole buyer and sole seller of energy. So the geothermal plant, when in operation, will sell to Domlec, Domlec sell to the consumer or the customers. Okay? So that's the model that is in place to accommodate the generation from the geothermal plant. Now, with respect to what Mr. Astafans was saying, he's very correct. Domlec will, if Domlec runs efficiently, they will make a lot of savings. So what we will do as we go along the tariff review at some point, we will mention that we are going to apply key performance indicators to Domlec that they will have to adhere to. And we came up with about 10 of them that we will be definitely applying when the new tariff kicks in. This is to ensure that Domlec operates more efficiently and reduce wastage in various areas. So we are cognizant of the fact of inefficient operations in certain areas, and therefore we will be putting measures in place as the regulator to ensure that we curb those inefficiencies. Okay, so Mrs. Lee wants to say something, so I'm passing on the mic to her.
Yeah, just to add to what Mr. Astafan said, we of course know that the WACC, or the weighted average cost of capital, is used to derive the rate of return to be applied to Domlec assets. But from a regulatory standpoint, what us as the regulator is concerned is it will be applied not to all of Domlec's assets, but to assets that the Commission considered to be regulated asset base. That is, the assets that the Commission think that Domlec will use, that are considered used and useful during the tariff period. So in 2021, as part of the tariff process, the IRC conducted an audit of Domlec fixed assets. So we traversed all over the island. We look at the poles, we look at the generators, we look at the network assets using their GIS system, and we did an audit of Domlec's assets on a sample basis. We found some minor irregularities, and we therefore increased our sample size just to ensure that what we are testing to is fair and reasonable. We did that for the fixed assets, and we did that for the inventory assets, the items in inventory. As part of the inventory items, we also looked at slow-moving and high-moving items. So if there are slow-moving items that have not been used for 5 years, and based on our review, we are of the view that they will not be used for 5 years, then some of the assets will be disallowed into the rate base. So, just to clarify that the rate of return will be applied to the regulated asset base. These are the assets that the Commission consider to be used and useful during the tariff period. And the tariff period is a period of 3 years. So even if Domlec have assets there or inventory there and we know that they will not use it, we are not going to allow it into the tariff.
Thank you.
Thank you.
Connie, please.
Yes, thank you.
Your question.
My name is Felix Julian. I work for Domlec. Based on some of the things said, I think there was a lot of emphasis put on Domlec being a monopoly. And so I would like to say a word on behalf of monopolies. The reason for having an electric monopoly is not arbitrary. In the past, in larger countries, people tried to do competition with things like electric utility. Now think from a practical point of view, what does that involve? It practically involves if a company comes and digs up the street and plant poles, another company would then, as a competing person, would have to come and dig up the street a few years later and plant poles. And if you had a third company, they would have to dig up the street and plant poles. That is not efficient because there's a limited number of customers, right? And so for the society, competition in such a highly capital-intensive exercise is less efficient, right? A company doing that would have to provide a much higher price in order to be able to support that kind of infrastructure investment. So imagine in Dominica you had 3 electricity companies doing the same thing. They would have to run the same amount of line and divide the customers into 3. That is not efficient, right? And so, therefore, as you would observe in a lot of companies, even the very large companies, there would be many different utilities, right? But they might be state monopolies, regional monopolies. You may have several companies, but they are monopoly in that area, and there's another monopoly in another area. Because that's the most efficient way of delivering something that is so capital intensive. So, Domlec being a monopoly is not a negative thing for the country. It's in fact a positive thing, right? And that's where you have a regulator. Now, the regulator's job is to make sure that Domlec does their work in the most efficient manner possible. And that's why they would disallow certain assets that they figure, oh, well, you wasted money on this. This will not be beneficial for electricity. So they will not allow it, right? So I think the methodology that we have to follow is the methodology, right? And the other thing about using, I think the regulator is right not to use the regional companies because Dominica is one of the places, we're a small country, we sometimes need foreign investment. Now if a foreign investor has to come, they need to be able to analyze local companies based on what they know, the international standards. And if you were to use something that is not well understood, then an international investor will have difficulty assessing the viability of the company. All right? So I support the methodology, even if the general methodology, even if I may have issues with 1 or 2 of the decisions that the IRC made, right? And the one thing I would say that I have some question about is if they apply the level of risk that's appropriate, right? I think that the country risk is applied in the normal financial sense. We're an emerging market, so they apply that risk, that's fine. But Domlec still has a great problem with finding insurance for our external assets that are exposed to hurricanes, etc., in a region where there are increasing risks for external assets. Does Domlec need a greater amount of returns, a greater risk premium? That question can be asked. But in general, I think the IRC has got it right in terms of the methodology.
Thank you very much for that contribution. There being no further questions from the audience in person, I want to move to the first consultation question. And we're going through all consultation questions, which we will pose to the audience for feedback. Would it come up? Or should I? Okay. Is it printed and I can articulate it? Yeah? Would that be easier? Great. Okay, it's going to come up just now. I just saw a snippet of it. These things happen from time to time. That's all right. So if we can start on slide 2. Right. So question 1, as reflected on the screens, do respondents have any view regarding the proposed capital structure for Domlec should be set at 46.6% debt, 53.4% equity? If not, please explain why. Any views? I heard an in agreement. All right then. So, is there, and I want to ask the question, and I know I'm veering left, and we're approaching lunchtime, is there anyone in the room that requires further explanation as to why this is being asked, or what is being asked? No. Great. Question 2. Do respondents agree to use as the cost of debt the proposed interest rate of 5% based on Domlec's long-term debt? If not, please explain why. I see there's a chorus and the room says aye. Aye. 3. Do respondents have any views on the proposed use of the US 10-year Treasury bond as of July 2023 of 3.75% be used as the basis for fixing the risk-free rate for Domlec? If not, please explain. And there's one hand. Can we get the mic? Yes, please. Please state your name and your organization for the record.
Sharon Devenesa, Ministry of Finance. I would like to know the rationale for using July 19, 2023 as opposed to any other day in July 2023, because what Domlec proposed, an average of December 2022 to May 23 would have that average, so it's not like the acceptable as opposed to using a particular date, July 19, 2023. When I did my research, July 19, 2024 is 4.25. Even the 9th of August, 2024 is 3.94. So using a particular date, July 19, 2023, what's the rationale for using that date?
Yeah, just to add on, Mr. Minister, at the time of doing the WACC review, the information, it was done in 2023. So it was on mid of 2023 when we were doing a thorough review. So we used the most recent data available as at that. Had it extended to 2024, then we would have used 2024 data. And also our test yield is applied to 2023. So it was done in 2023, it was the most recent information, hence we use that data. And going back, based on previous research done as part of our review and analysis, we found that among the other regulators, they use those figures as well. So it's more or less the timing of the exercise.
And so, does the room say aye? All right. I just want to make one point shared by one Shirley's Cook on social media. And I think that it's fair, given that we're engaging on all platforms, for us to address. And she said, I'm not a statistician by any stretch of the imagination, but the comparison to U.S. public utilities is flawed. I understand that Domlec would invest through the S&P, but comparing Domlec's risk factor with other small, similar-sized countries and geographic locations would hold more weight. How would you respond to that, Connie? Or Mr. Keys? I don't. Yes? Okay.
Yes, we note the concern, and the issue is because of the smallness of the sector, of the region, much information is not available. Even so, in recent time, we know that some of the utility companies within the region that are now fully owned by the government of the region, they are not publishing the annual report. So the relevance of it is the access to data. And this school of thought require you to use Match Your Market, where you have a wider range of data available.
Thank you very much, Connie, for addressing Ms. Cook's question. And we go to question 4, as we already have consensus on question 3. The respondents agree to use the Commission's proposed A2, am I saying that correct? Sorry, propose all U.S. power utilities as the proxy utilities proposed by IRC, or 15 U.S. power utilities recommended by Domlec. So I butchered that the first time, I'm going to go again. Do respondents agree to use the Commission's proposed all U.S. power utilities as the proxy utilities proposed by IRC, or the 15 U.S. proposed power utilities recommended by Domlec? Please provide reasons. So I want, yes please. So you are saying that you prefer the IRC's proposal. Why?
Well, because I can't remember the full details of the difference between the IRC and the 15 power utilities that Domlec used. But at the time when I was reviewing it, I believe it had a wider range, and basically it provided a percentage that is more in tune with the reality on the ground. With the 15 US power, I think you will get in a higher percentage.
Correct. So with the 15 US power, we will get in a beta of 0.66. With the all-inclusive US power company, we will get in a lower beta of 0.44.
Okay, I would also use all US power company, as it would remove the biasness of choosing 15 US company. Yeah.
Any other? Yes, please. Go ahead.
Yeah, I just wanted to find out, because I know in the past, I believe, I'm not sure if I'm correct about that, the IRC used a different slate of companies. And the thing about this, using all US utilities, I think it's logical that you would get a lower beta, because you're using companies that may have vast assets, have businesses that are not all electric businesses. So you will get a lower beta for companies that are a lot safer investments. The thing is, because of Domlec's location and size and all that kind of thing, well, I just wanted to find out a little more about the rationale for using all U.S. companies, maybe.
Connie?
They were all U.S. electric company. So they were not any other thing. They were comparable with Domlec. They may differ in terms of whether it is vertically integrated or not. But they were yes, unregulated or unregulated. So it is a vast. And what we are saying is that there is no exact or perfect company in the U.S. that would match with Domlec. And we also factor a level of country risk for, looking at the internal risk that would affect Domlec's operation. The best would have been to use countries within the region, but if data is not available, you cannot use it.
Also, there's a school of thought that dictates that you can look at the companies within the domicile, like in Dominica, and what their risk factor, or what risk factor they will be exposed to. They may not be electric utilities, but other companies within the jurisdiction that you can utilize to assess or what risk factor applies to them. Okay, so that's one of the approaches that some of the regulators use to as a benchmark to see how far that the quantities that we determine deviates from the normal.
Thank you very much, Mr. Keys. So, consensus in the room for all U.S. power utilities? Aye? Noted. I saw a hand. That hand was aye, yes? And the ayes have it. Moving to question 5. Do respondents agree that the small company size be excluded in the computation of cost of equity for Domlec, but rather the country risk premium of 3.08% be factored in the calculation, as well as equity risk premium of 5.06% be factored in the calculation instead of 8.27% proposed by Domlec? There's a question.
So I have a question. What exactly is the 8.27%? Is that the small company size risk percentage? Or is that just the number that Domlec came up with? And if it's not the small company size risk, what is the small company size risk?
Over to Tony.
Yeah, the 8.27% is Domlec's equity risk premium. And for the company size, it was just give me a minute, please, so that I ensure I give you accurate information. Small company size adjustment was 0.79% proposed by Domlec. It's on page 31 of the consultative document.
Is there a mic? Just for the record. She's right in front. Yes, for the record, so that everyone hears.
Sorry about that. So my question is, if the small company size rates, I'll use rates because it's a percentage, is 0.79%, why are we using the country risk premium of 3.08%? How does that benefit Domlec?
Well, it's a higher percentage, of course, and we have the view that embedded in the country risk premium, it takes into consideration any risk associated with the smallness of the country and the economy, or any risk associated with inflation or economic development or recession. All that, of course, would be is somewhat factored in the country risk premium. That's our view. But as we said, the equity risk premium, it's based on the data set recommended by Domlec in terms of what they use. They use S&P, and then we use different data sets.
Okay, so just for clarification, instead of using a total of basically 9.06, my math may be off, which is the 8.27 equity risk premium plus the small country size premium, we are using the country risk premium of 3.08 plus the equity risk premium of 5.06.
Yes.
Correct?
Yes.
Okay.
Thank you.
Thank you very much. Any more questions? Or does the room say? There's a question? Yes, please.
I would have argued something for Domlec, but when I looked at that 2023 report, okay, where you have the shareholder is the government, and they did not give any what you call related parties, which is a requirement. I'm not an accountant, but the gentleman here could help me with that. And registered companies on any stock exchange have to have related parties accounted for. Yes. So we do not know what debt the government has for Domlec, which is the shareholder. And I support the IRC on that tremendously, because your last statement, as I think, in terms of related parties, is not transparent. We need transparency, and Domlec need to ask for 8.27, they need to be more transparent. So I support the IRC in that regard.
Thank you very much. And we have agreement?
Yes,
we say aye. We go to question 6. Do respondents agree with the Commission's proposed beta of 0.44 for all U.S. power utilities to be used as proxy beta value for Domlec? Please provide reasons. Please, I didn't hear that one. You think it should be lower? Lower?
0.3. 0.44 is even too high.
Say why?
The reason I even using all US data proxy beta choose 0.44, but if we are to use the Caribbean setting and the way in which Domlec is operating in terms of the ability or its inability to shift in terms of if something happens to the market, it will not be that volatile. It will not impact it that much. They will still get the same amount of money they get in. It will not change unless it's a hurricane that stops everything in terms of the no more generation and they have to rebuild. But other factors, like economic factors, is a basic thing. They're still going to get the same amount of business, and because of they're the only one providing the generation now. So I think the 0.44, if that's the only data we have, we'll go with it, but it should be 0.3.
Thank you. Well noted. Any other comments from the room? Yes, please. To the front. To the front. Yes. Right here.
No, I think it's always very satisfying to say that Domlec should have lower rates or make less money somehow. But I think we should all be aware that the company needs money in order to keep the system maintain the generators, etc. If the revenue is too low, what you will get is over time a deterioration of the whole system and more blackouts, right? I don't think anybody wants it to get worse. I live in the south, in Castle Comfort, which is one of the areas that is on what they call frequency related outage. So when the frequency drops too low, I'm the first circuit that goes out. So nobody wants the service to get worse. I mean, that affects the economy, etc., etc. So it's about finding a balance. It's not just about saying that Domlec is making too much money, because let's face it, Domlec isn't making any money for the past several years. You know, so the prices of items since the pandemic has really increased significantly. Just shipping items. Sometimes I order things and I have to wait a full year for it to arrive. I mean, that has a big impact. And so, I mean, we have to think about being fair and equitable and thinking about the best interests of the country, not just lower prices. Yeah.
Thank you very much. So generally, as it stands now, at a proposed beta of 0.44, do we have consensus on aye? Yes. And the room says aye? And we go to question 7. Do respondents agree with the Commission's proposed... Pardon? 7 seems the same as 6. Yeah. Because 7 has to do with the WACC. So then I would just say, is it there, or I can read it out. Do respondents agree to use the Commission's proposed WACC post-tax of 7.90% and WACC pre-tax of 9.82%? Is that accurate? Okay, so let me see the entire bit. So we go again with that question. Do respondents agree to use the Commission's proposed WACC post-tax of 7.90% and WACC pre-tax of 9.82% compared to Domlec's proposed of 9.30% post-tax, and 11.63% WACC pre-tax? There's a hand there.
Paul Moses, Domlec. I'm not going to answer the question, but I just wanted to make a submission on that. Hopefully that could influence the answer. Felix Julian made some very good points. I mean, I'm a consumer myself. I'm interested in lower rates. But at what cost are we going to get those lower rates? The country risk premium we looked at earlier on, I don't know to what extent it's considered the specific country risk that small nations like Dominica are faced with every year during the hurricane season. Maria was a very good example. Felix said we have not had a profit at Domlec for 7 years. Several years. And certainly after Hurricane Maria, that ought to tell us something, the extent to which Maria impacted Dominica, and in this particular case, Domlec's performance. We have not recovered. The course after Maria, we had COVID-19, we had the issue in the Gulf with shipping supplies being redirected. Costs of materials that Domlec uses have gone up tremendously. So I am not sure whether to what extent the country risk premium took that into consideration. Maybe it's difficult to cost that. So I would propose, because of those considerations, I looked at the increment, the difference between what Domlec is proposing for the WACC and what the IRC responds with. And it's almost a 2 percentage point difference. When you look at it, it's almost 2 percentage points. 11 point something compared to 9 point something. I would propose a compromise, an average between the two, just to make allowance for those risks that may not have been adequately computed with regard to the risk associated with the weather systems impacting our region.
I think, Benjamin, you mentioned that IRC will be considering other factors. Okay, since he took in the matter with the hurricane, I was wondering if a factor that we have to look at is something that Domlec could cover. It's something that the Public Utilities Act of 1979 or something had in it, where the utilities had to put aside a percentage of their revenues that they cannot touch, but will be there. Because like he, I'm concerned, but when I see the report lacking data that is essential for any qualified accountant to put in it worries me. Okay? Which I mentioned before. So I would like to see that. And I know one of the things we found out that occurred in Domlec and in Cable and Wireless, you know I fought Cable and Wireless. And I won. Nobody gives me credit for that, but I don't need it. My food bill is down, so that's all I do. Okay? Gold plating. Because I followed a piece of equipment that was sold to Jamaica for $40,000, sold back to an entity the public utility owned in Cayman Islands for next to nothing. Okay? Because they bought it because it was too small. And then they added a few $100,000 to it and sold it to Barbados. Then they bought it back at a loss, claimed tax credits on it, and then it ended up in Dominica 20 years later at over $5 million. Okay? And I don't have to call the utility. Okay? And this gold plating, IRC have to recognize it was critical, because when I was on the board of Domlec and I look at their plans and purchases, myself and the chairman, Trevor Burton, and the board at the time, we put in place certain things. And just by having a staff audit to ensure that the right staff was in the right place, and that the reports we were getting from management were accurate, then within 2 years there was a profit of $3-something million.
Yes, yes.
You understand?
We agree. I agree with that.
Okay.
Entirely. Okay, so with respect,
I support him on average, but I would like to see us taking measures that would, and what you mentioned, to ensure that Domlec is on the right foot. Its losses are down, and it should get some benefits. But there must be, for Dominica, we have to invest in that race with the people. And there must be some money that when we invest in it, can put aside every year an annual amount of $5 million. No less than that, or even more for Domlec. Because then they will have the resources to meet any disaster.
okay, so an application, well, the RC was consulted for its opinion to provide an opinion on self-insurance, and we provided an opinion to the government on self-insurance, and basically we stated that it should be applied in the form exactly basically what you say. So that is still a work in progress. With respect to gold plating is a concern to any regulator. And moving forward, we want to ensure that Domlec does not engage in such behavior. As you said, if we can get Domlec to operate more efficiently and curb any wastage or instances of gold plating, they will definitely save money. Okay, so I agree entirely with your position on that.
Okay, Mr. Moses, we noted your concern, given the extensive rise in cost level of inflation and the need for whether we could try to fit within the gap to allow for a review at the country risk premium to allow for a higher return for Domlec, or also you noted the difference between the 9.8% and Domlec proposed figure, whether we can reach a leverage. At this time, we cannot give a definite answer. What we can do, probably we can discuss it further between Domlec personnel, so that if they run the model using IRC's figure and run the model within Domlec figure, whether Domlec can remain afloat with IRC's figure, and how much it would differ if we reach a cutoff. So at this point, we cannot say that, but we can have a collaborative discussion to see how applying the figure would be reflected in the rates.
I see 3 hands. I see that there's...
if we do that, we have a 14-day window where also stakeholders can give their feedback and all that can be taken on board.
Okay, because my question was where is the consumer there in that process? No, I said they have a discussion after. No, I just wanted to know where would the consumer would fit in what you just suggested, that you all were going to have some discussion and
well, of course, we would have get back to the stakeholders as to what our findings are, because we are not going to make a decision now. So if it means that we may have to have another forum to bring those concerns to customer, if it is feasible, then I think that's something IRC would be willing to take on board.
I thought he's representing Domlec, right? Yeah, but you all have had meetings and discussion with Domlec, right? Did that be taken into consideration then?
I am in favor of speaking to the RC and presentation. I think what what's needed in Domlec case. I think Domlec needs to be more efficient in the operation.
Agreed.
One, two, the type of equipment that they buy to use to generate electricity need to be reviewed. I don't know how they're using this type of equipment. Recently there was some, because of the urgency, some high-speed generator that would burn way more fuel than a normal generator. I never meant why at this stage they never consider a bunker C generator that can use cheap fuel like old oil and those sort of things. I don't know if they're not thinking of those things there. But recycled oil, when the ships come in, they give the oil. DCP has that for 30 years now.
Heavy fuel oil.
Yeah, heavy fuel. And I don't know why government at this stage not using that. I'm not too sure. So, anyway.
Yeah, so moving forward, we expect the geothermal plant to be in operation by the end of 2025. That's next year. So, with the onset of the new plant, some of Domlec's old generation assets will be retired, some of them. So, in moving forward with the more renewable energy that's being added to the grid at a utility scale, the less diesel that will be utilized. So, Domlec has, most of its engines are medium speed. And this, we hope to eradicate diesel between now and 2030, the use of diesel. Okay, so if all plants go through, we should see geothermal and hydro forming most of the generation. And the newer diesel engines that still have useful life will be put into cold standby for purposes of when the geothermal is being maintained, or if there's a breakdown or something to meet the demand. So moving forward, we will have different sessions with the public to explain all these things in detail that they will be able to understand. Okay, I don't want to take up much more time because we are coming to an end, and I'd like to let you finalize the portion.
Thank you very much. So, just a consensus on the last question. Is there agreement? Generally? And the room says there's one. I see two hands in the back. So, one and then the other. Go ahead.
Well, my comment was that based on the suggestion that I made, which was supported by a representative of the consumers, shouldn't we amend the question to say, for example, that the IRC, like this forum, authorizes the IRC to look into just what Connie said, to look into the possibility of getting a compromise position. So rather than put the question before us as it is in this present form, but mandates the IRC to consider that compromise position, and once they have made their research, done their determination, the question will be answered then, rather than now. That's what. And just one quick point here, in terms of the cost, and Domlec being more efficient, of course, as I said, I'm a consumer, I'm all for efficiency, but a key word that came after Hurricane Maria was resilience. Resilience comes at a cost. Domlec discovered that, for example, the poles, to get more resilient poles, it has cost us much more than the poles that we were getting before. So that comes at a cost.
One more. No, the lady right behind you had a point? Okay, great. So there's one here.
No, I noted in the document that the IRC was saying they had extensive consultation with Domlec. And then as a result, Domlec went for the higher figure they were proposing. So figure Domlec would have known what he's speaking of. So I don't see the need for us to go back and litigate the whole thing again.
Well noted. There's one comment here and one here.
Mr. Paul, I note what you're saying, but a decision hasn't been made, right? When a decision is made by the regulator based on the input of everybody, then the utility might have a formal response to that. I am not involved in it. I'm speaking more as a member of, an interested member of the public, because I am not associated with the tariff setting process at all. So I am fully unaware of what they went through, but I note what was said in the document. So I'm assuming when a decision is made, the utility may have a formal response to that, which may be, we are in disagreement, whatever, and here is why. I don't know. I'm unaware.
Yeah, and I totally agree with you. And this session is for all the stakeholders to have their input, to allow the commission to make its decision. But the commission and Domlec have spoken extensively. So now is our turn.
Just a quick question. There was mention that at the 9.82, the IRC determined that at that amount, Domlec can remain afloat. My concern is with that word afloat. Do we want Domlec to be afloat, or do we want Domlec to be stable? And those two are not the same words.
We want Domlec to be viable. And when we propose, as part of our discussion, Domlec they said that they accept that figure. They accept to go forward with our recommendation, which is the 9.8% that will allow them to be viable. Yeah, well, it will allow them to make a level of return.
Afloat is the wrong terminology, because it's supposed to be viable.
No. I just wanted to say on this matter, since the IRC is considering that risk associated with hurricane, we can leave that like that, because that risk is one of the greatest risks we have. You have another risk where you have with the shareholder, the majority shareholder being responsible for certain things. But putting that aside, I think we can put Domlec in a situation where it can meet the demands of the crisis that comes. And that thing was exacerbated by Hurricane David, was their major customer left Dominica, the income earner, which was Ross University. So that will change. But in terms of putting aside something to meet the disaster, both Domlec and the WACC has to do that. But it's a fund that the people, not the government, but the consumers can monitor every day. It's online, you can go and see that they're not touching it. Because when the disaster comes, we suffer it, okay, the consumer.
You have 1 minute.
So just to clarify, as indicated, Domlec has accepted, they feel that the 9.8% proposed by the IRC is quite reasonable. So just to lay the foundation. So it's up to with the stakeholders, or the stakeholders excluding IRC, to decide whether we go with IRC's figure or whether we go with Domlec's figure, or whether we go to the concerns expressed by Mr. Moses. However, any level of risk is factored into the country risk premium. That's why the country risk premium is factored. We looked at government bond of 7%. We deducted from similar investment by the US market, we got 3.8. That was Domlec figure proposed for the country risk, and IRC agreed with it. So any other internal risk, it is factored in the country risk premium. So again, do we go with Domlec figure or do we go with IRC's figure?
And the room says aye. Right. I want to thank you for being a very engaging audience. I will admit there was some nervousness when we saw there weren't many more people joining, because you wanted to have that very thorough discussion. I would say that the questions asked, the suggestions raised, and the further explanations that were provided really added depth and context to the lay public looking on. So I want to thank everyone in this room for their contributions. I also want to thank those online who also sent in their questions or made respective comments. I'm going to hand over now. Okay, I preceded the what the executive director was going to say. So now I'm going to ask Mrs. Florestine, who's the admin manager at the IRC, to please join us here for the vote of thanks, and I'll hand over to her. Thank you kindly. Thank you. Okay, hope you had a satisfying session with us, and my task is simple, and we will make it short and sweet, right, Ilona? Okay, good afternoon, everybody. It's now afternoon, and I will soon provide you with a small snack so you can mellow yourself before you leave, okay? But before we leave, we would like to say thank you, and of all the many things in life, gratitude matters tremendously, and I'm sure we all will agree. So as I'm graced with this opportunity for and on behalf of the IRC to extend our thanks and appreciation, let me first of all thank the Heavenly Father we prayed earlier on, His presence, His intervention we appealed for in our discussions, and He has indeed been gracious to us, allowing the events of this morning/afternoon session to flow successfully. Now we are quite aware that without your presence, our participants, as the stakeholders, the consumers of electricity, today's consultation would not have been what it has been. Whether you are here in person, and for those who are online, listening via the media, Emonews in particular, as a consumer, a customer, an investor, an employee, a supplier, whoever you are, we say thank you. We are convinced that your contribution in this discussion, and as such, it is very needful, and as such, we are thankful for your fruitful participation. There would definitely be a void without you. So thank you for heeding to the call, for your indulgence, for reading through that very deep academic and whatever name Mr. Doribel called it material, and for indulging with us today. We also extend thanks to Domlec's consultant, Mr. Bill Vinage, who is online, and the audio is a bit poor for them, so we ask that they bear with us. Thanks for making yourself available, considering the juggling of your calendars, of our calendars in particular, to accommodate today's event, and the mutual commitment towards reaching the goal. We commend you. Again, we have had our differences, but at the end, we are thankful that we got to an understanding and to understand each other
We are happy that you made the effort to come and to be with us here to explain as much as you possibly can to our stakeholders, your side of how we come to this agreement. The comradeship that evolved during our discussions throughout, we are tremendously thankful for. Thanks to Miss Lamis. She's not here with us, but she was one of our consultants, and Connie mentioned her earlier on. She works with the consultancy firm in France, that's Paris Infrastructure Advisory. Her service to the IRC was above and beyond, and we are indeed thankful. Our Executive Director, Mr. Justin Case, thank you for your leadership role in general, but specifically your passion, your enthusiasm, and your insight as we continue to go through this tariff review process. Bear in mind, this process is not a pie in the sky, it's not a day on the beach, Jason. At Miro, it's not there, but it definitely involves a lot of discussions internally, externally, and there is a fair share, there's lots of rumblings here and there, but we are making it through. So thank you, Mr. Kiss. To Domlec's other representative, Mr. Clyde Edwards, who is on there, Mr. Quentin Gregoire, who form that deeper part of the negotiation team. Thank you very much. We continue to thank you for your enthusiasm and for your collaboration with the IRC. And I want to thank the entire staff of the IRC, but before I do that, let me thank Mrs. Louis. Mrs. Louis has been the one behind these figures quite a bit, along with the team at Mr. Justin Casleys and Mr. Jason Timothy. So these three, they really push a lot, and we thank her very much that she's always on par to answer the questions and to do her best to explain it in the best possible layman terms as she possibly can. Great job, Con. Thank you. Thanks and kudos to our IRC staff. We work behind the scenes, we push. Idona is our communications officer and very involved in getting these consultations going. And we have Dennis at the back, we have Nikita, we have Nikes. They are there quiet, but working behind the scenes. Thank you so much, so much, so much. I don't want to forget anybody. Our USAID RTI personnel, Tioka, made a difference or supported us today. Thank you so much for helping us in the question and answer segment. And I'm sure that you appreciated that extra accent with us today, right? Can you tell where she came from? Or you don't know the accent? You said where, Julian? Oh, I thought somebody said Trinidad. Thanks to our IRC representatives, CRC representatives, that's our consumer relations representatives. We have a few of them here, and they do support the IRC behind the scenes in the communities. The other Domlec representatives who are here, thank you for being here, for always joining in to give us a little boost here and there. We appreciate it, Mr. Moses. Thank you. And Solange, and Julianne, and Mr. Bedminster. Did I miss out any other Domlec person? No. And I began by thanking our stakeholders. Again, I just want to call you out because this is a challenge that we have in getting our stakeholders to participate in that very nice topic, or the different lovely topics that we discuss with Domlec. They don't really like it too much, but I'm happy. We are very thankful that you made the effort to be here today and to support us in that effort. You matter because it's all about your pocket. Great. And I'm hoping that I got everyone I did. If I left you back, don't give me slack, okay? And again, at least, we would like to encourage everybody to continue to participate as we go along. Our ED mentioned that, and we continue to participate. Thank you. Emonews, thank you. thank you for making us reach the world and beyond, not just in our little space, but beyond. We are very thankful for the support, etc. And to those who could, all of you who could, especially our external, our consumers, Mr. Astokan, Mr. Doribel, and Miss Romans. Your questions were very, we appreciate the contribution that you make to the questions, and we are sure that you will continue to reach out and to be part of our consultations going forward. And with this, I would just like to say thank you to everybody again. Thanks. We have some snacks that we will share, and Idona will continue to take the mic from me. God bless you.
I mean, I have nothing else to say but bon appetit and thank you, Mrs. Laura.
Thank you, IRC.
This was the Independent Regulatory Commission Stakeholders Consultation. We'd like to thank all the viewers for joining to have a listening.